it's kind of general belief the equities will do well in the next 12 to 8 months, and it's my belief that in the next month, 1.5 months, we might see a successful conclusion of the negotiation on the bilateral debt restructure.
If you look at the monetary easing policies that have been started being implemented from June onwards, so really there's not a lot of time to catch up in terms of GDP, so we think still we'll see a marginal decline.
We think annual average inflation this year will be 23%. We are expecting 1% decline in real GDP this year. Next year, we are expecting 5% inflation.
Index is a question we really don't try to think too much about, but we do have substantial exposure to tourism.
Hello, it's late August 2023, and after a mad rush upwards, stock prices have cooled in this month, coming down off their peaks. But overall in 2023, the market remains up over 30%. And at this point, still, it looks like having a disproportionate share of your investment in equity makes a lot of sense given the underlying conditions. And to discuss the idea of how to craft an investment or equity strategy in the current climate, we have 4 fund managers. So they're all from the buy side of the business of equities. They are buying assets on behalf of clients to manage, hence the buy side. And Asanka, Herath, we'll start with you. Now, Asanka is head of equities at Lynear Wealth Management, a fund management company. You both manage funds on behalf of individual clients and also portfolios of third parties, right, Asanka? And let me start with asking you, what do you think are the forces that will shape equity valuations in the future?
Yeah, interesting question, Shamindra, and thanks for the opportunity. I think it's kind of general belief the equities will do well in the next 12 to 8 months. And very briefly, if I have to kind of identify what can drive the equity markets in the short term or in the next 12 to 18 months, I would say it's my belief that in the next month, 1.5 months, we might see a successful conclusion of the negotiation on the bilateral debt restructure and the commercial debt restructure. And also all these conversations about domestic debt restructure should also end with that. And that will be a major catalyst for both the economy and the markets. And you should see a lot more confidence driving the equity markets upwards, both through foreign fund flows as well as local fund flows. We also expect the rates to come down further, 200-250 basis points toward the end of the year. Then corporate earnings may have bottomed out, and we expect the corporate earnings to start growing from this point onwards. So I think it's a culmination of all those 3 factors which will drive the markets forward in the near term.
Vindhya, welcome. It's great to have you here. Vindhya Jayasekera is the Chief Investment Officer at NDB Wealth Management. NDB is a commercial banking group. NDB's investment banking arm is where you are based, and in asset management in particular. Vindhya is Chief Investment Officer at NDB Wealth Management. Let me ask you, Vindhya, in 2022, there were some factors that were potentially bearing down on equity valuations. What were those factors? Are there standout ones, and have those changed in 2023, you think?
So Shamin, so last year actually was a story of interest rates, right? I mean, we started the year with low interest rates of about 8%. But as we went along, we saw that with a 700 basis point rate hike, interest rates went up to about 23%. People had the opportunity to invest at even 30% returns. And now this year, if you look at where your investments are starting to mature, because a lot of people didn't take the opportunity sometimes. I think there was a set of people that didn't take that opportunity to really lock in the rates at that time. And some of these investments are starting to mature. And today, the interest rate environment is around 12-14%. So I think people are going to be yield hungry. And I think this is going to be a catalyst for some flow that's going to come into the share market. As well as if you look at taxes, there is a tax story behind a lot of money that can flow into the share market as well. Because fixed income instruments will get taxed at your tax brackets, the interest earned. So at the highest tax bracket of 36%, if you were investing in a 30% fixed income instrument, no problem, but you get 20% to your hands. But at these rates, your after-tax returns are going to be 8 to 9%. So again, I think there's going to be money flowing. With that, there's going to be some catalyst coming into the share market. This added to the fundamentals that Asanka was talking about in terms of the macroeconomic turning. There's a lot of policy easing that will go on, as well as undervalued shares. I think there is a good case for the share market to really see a good performance over the next 12 to 18 months.
Thanks. Kanishke Mannakkara is Group Chief Operating Officer at CAL, but he's here at the table because he represents the buy side as Chairman of CAL Investments. That's the asset management arm of the group, Kanishke. Thanks for being here. So we've heard two views, fairly... if you were to add something to what's already on the table about the factors you think will shape the investing environment for equities, what would those be?
At risk of repeating what my colleagues have already said, I also agree. I think there's a lot of upside. It's driven by, sort of two things that I always think about from an investment principles perspective. One is that, especially in frontier markets, you make the most amount of money when things go from terrible to bad. Market has gone up by 35%, but that's still early days. Expanding on that through a fact, adjusted for inflation, the ASPI today is lower than it was on the 9th of May 2009, which happens to be the day the war ended with Prabhakaran's demise. So if you consider that, Sri Lanka today is a vastly different place, sure, the growth outlook is lower, but from an overall economy perspective, it's significantly higher. The stock market hasn't gone anywhere. That represents significant undervaluation, and that catching up that gap presents a significant upside in the very near term. For me, 12 months is near term. The second fact is that bad times lead to good policy, and good times lead to bad policy, often at a national level, even at a company level sometimes. And so the very bad times that we have gone through have led to, so far, good macro policy to get us out of this. Provided there is policy continuity, there can then be a period of growth and prosperity beyond the 12 to 18 month horizon that we're talking about here. And that could give further upside on equities. So for both of those reasons, I'm also very bullish.
Okay, so let me try to see to sort of untangle one or two of these. Terrible to bad, how do you make this distinction, that we are still that terrible versus bad?
No, I think we've gone from terrible to bad
already,
but
okay.
I would argue the equity prices haven't adjusted fully because 35% is nothing in the grand scheme of things, considering how far we fell, considering there's been 70% inflation, 35% isn't much, and considering how far the market has fallen.
Right. Okay, so coming to the wider conversation and looking at the at the prospects top down. Okay, so we're looking at macro and then looking at, okay, what does that say about equity valuations currently? I'll come to you, Asanka. I suppose what you expect in terms of GDP growth, interest rates over the next 12, 18 months will matter. Can you put us into a frame of what you're anticipating will happen in those areas?
On GDP growth and interest rates. So I think we possibly expect the 1-year treasury bill to end around 11 to 12%. Worst case, by end of the year, it can be possibly lower, right? And the the real GDP growth rate can be will be under par. It can be about, I would say about close to 4%. But
4% negative.
No, next year's real GDP growth rate can be about 4% positive. But that should not deter, as I was telling you earlier, from thinking that corporate earnings will be will be lower, because you have to remember the accounting profits of companies are denominated in nominal terms, right? Given the high level of inflation we've had coming through, I feel that if you take the non-financial sector companies, I would say they will at least report 30 to 40% nominal earnings growth starting from this point, and it can be substantially higher, right? And if I move into, I would say, the financial sector, don't be surprised if the book values of the banks even this year ends up growing in the range of about 10 to 20%, given the kind of bond position they have put on, and also the growth in the nominal book. I mean, if I just can take 30 seconds to expand, and this relates to Kanishke's point also, we have gone through hyperinflation, but we have come to the end of it. At least it's inside. That means the prices are elevated. Essentially, that means the nominal prices of every product that we sell is much higher. That means the nominal markup is higher. So you don't need to have the volumes recovering to the pre-crisis levels to get substantial earnings growth.
Sure.
So I think that's why I disagree with our good friend Vajrapani from the last podcast. I feel that there will be substantial earnings growth especially starting from now on.
Right. Vindhya, let me bring you in. Again, on what you anticipate with GDP, you can look at 2023 and also potentially 2024, and what are the likely impacts also because of interest rates. You mentioned there'll be a shift in investment.
Yeah, I think I'm essentially with Asanka in terms of GDP. I think for 2023, you're looking at only the first quarter numbers are released and the quarter one numbers are at 11.5 negative. But if you look at the monetary easing policies that have been started being implemented from June onwards. So really there's not a lot of time to catch up in terms of GDP. So we think still we'll see a marginal decline for this year, probably in the low negatives, -1% or so. But next year, we do think the base effect will also come into play, as well as the government will also look at further easing in terms of the central bank as well, will also look at further easing of policies because they are very interested in growth. If you think about even the fiscal policies, you're looking at, there's a question on whether we'll achieve our revenue targets. Part of the reason we can't achieve our revenue targets is also because our economic growth is not enough to really capture that tax collections. So there will be substantial earnestness in terms of promoting that economic activity. So I think we will see, like Asanka also said, we are also of the same view, probably around 250 to 300 basis points type of reduction over the year, not this year, but over another 1 year period or so for interest rates. And GDP, again, to be in the range of about 3% for next year.
Kanishke, do you agree with the thesis being floated that, we are at a U-turn on corporate profits here?
Yes. In short, yes. I've had the benefit of being able to think about it for a few seconds longer than these guys. So we think annual average inflation this year will be 23%. And we are expecting 1% decline in real GDP this year. So nominal GDP up 22% this year. Next year, we are expecting 5% inflation. And next year, we are expecting about 5% real GDP growth. So nominal GDP growth of 10% next year. Interestingly, we see the U in GDP happening already. So actually, Q2 numbers are not out yet, but our forecast is for a 1% up on Q2. And Q3 and Q4, we are forecasting between 4 and 4.5% growth for the second half of this year. Because we spend a lot of time modeling the macro, so these numbers are fresh on my mind. In terms of interest rates, we think by the end of this year, T-bill, 1 year T-bill should be something in the region of 10 to 12. And we think that T-bill should end between 8 to 10%, within the next 9 months to 12 months. It should find, and then that should be a relatively stable place for it to then move from, depending on how the macro how we manage monetary policy thereafter.
So let's also talk about earnings. Where do you think 2023 earnings will go to? We've only seen one quarter of results announced yet. Any sense, any chance that you can tell us what do you anticipate in 2024?
So I assume you're talking about FY24, which is
You can take it as calendar
Let's
or
talk
FY.
calendar
Just
year. So the June quarter earnings were out, and it was very low. So I think it was market earnings were in the 50 billion, 55 billion, something like that. And if you just multiply that by 4, it comes to 220. For context, market earnings in 2021 calendar year was about 370 billion rupees. Important to bear in mind that we've had maybe 70% inflation since the end of 2021 to today. So as Asanka said, even if you take 30% higher than 2021, and I just did these numbers in the office before turning up today, if you took a 30% up on the 2021 earnings for next year, I'm just at a very macro level, if you take that kind of assumption, you end up with a market PE of 6.5. So, gives you an indication at a time when interest rates are 10%, a market PE of 6.5 looks extremely interesting. In a market where you don't get taxed on capital gains on equities.
For context, quickly, the current market PE is what?
5.8.
5.8? Okay, about.
Are you sure?
Yeah, the current
On the
market PE
June-
on the trailing numbers are
On the
5.8.
Trailing 4
numbers.
quarters.
Yeah. But
is
if
fine.
you annualize the last quarter, then the market PE comes at like 18.
Yes, that's correct. So I think because last quarter the earnings came down over 60%, right? So the
Exactly.
quarter-on-quarter earnings came down over 40%. So yeah.
Just to add to Kanishke's point, just take this example. Now they just allowed importation of buses and trucks. The pre-crisis, the prices at which these will be brought down will be materially higher than the pre-crisis prices. So let's say the banks are to lend to bring these vehicles down. So just imagine how big, what will be the increase in the working capital lending of the bank simply to finance importation of these vehicles and extrapolate the NIMs on it. So which is why if it comes to banks also, though the banks have seen a substantial run from the beginning, if you actually value it on forward earnings and forward books, I actually think we are barely scratching.
Let's talk banks and look at what level of impairments they've made. What we are talking about is there'll be 2 phases to this. The first phase is where those impairments taper off. You start making fewer impairments.
Yeah.
Phase 2 will be write-backs of those impairments, right? Now, all disclaimers said, we may have interest in the companies that we're talking about. HNB, 31st of March 2023, net book value was 190 billion. They wrote off 92 billion rupees in the 12 months ending 31st of March 2023. This is a meaningful percentage of book value. If you start writing back some of these loans, because at 30% people couldn't afford to service their debt, at 10% or 12% they probably can. If you start, and 70% of the lending of Sri Lankan banks is collateralized. So you start writing back. You're talking about very significant book value growth. And then even, we think 70-80% price to book value is high. First of all, I don't necessarily agree, but that book value can increase dramatically.
Banks are trading at a book value, say HNB, for instance, at 0.5% book?
No, now no longer. It was. Now it's more like 0.7, 0.8.
Right.
But the book can grow so fast.
So actually, that's why I think I agree with Kanishke, and I will urge the audience to do their own modeling of the future book value. I think, correct me if I'm wrong, Kanishke, what we are trying to say is that right now, visibly, certain banks might be trading at around 0.7, 0.75 book. But if you model the write-backs of the impairments and whether they have over-provided for the ISB impairments, and also the bond portfolios carried on their balance sheets, and expected credit growth, I would say they are substantially undervalued. But once again, I have to be very careful. We may have interest on those positions.
So it's taken for granted that all three of you will have interest in the stocks that you're talking about. You're talking about the bluest of the blue chips here. It is very likely that you will have client money invested in these, and you will be advising clients to invest in these stocks. So the audience has to understand and appreciate the context that you come from. We will, anytime we bring a set of analysts or set of fund managers who are from the buy side, they have this challenge, right? So that's the context we're speaking in. So Vindhya, banks and finance companies, let me sort of slightly enhance this thing, right? And when you look at the numbers of what we call finance companies or non-bank financial institutions, right? Is PE a good way currently to think about how to value them? We've talked about book value. What about price to earnings?
So for the non-bank financial, for the banks or the non-banks, we would take PBV as a measure where we evaluate. We wouldn't really look at PE
Right.
so much. But even non-bank financial earnings, even if you look at the qualitatives, I think you will see that when interest rates come down, finance companies tend to perform better because they have long-term loans, but their deposit base reprices faster.
Right.
So there is NIM expansion there. And with the interest rates coming down, you can see economic growth picking up. With that, there is some stabilization in terms of loan repayments, ability to repay. So because of this, the asset quality also is on an improving trend. With all of these, again, finance sector looks attractive as well.
Asanka, you mentioned at the outset, you said you gave us some numbers excluding the financial sector. What was that number?
I said at least 30 to 40% starting from January corporate earnings growth.
In obviously nominal terms will be up. You excluded financial sector. Why did you exclude the financial sector?
Because you usually don't value financial sector on earnings growth. You value financial sector on book value growth, and that's why I made the differentiation. And also while the underlying macro factors which may drive both the financial sector earnings and the corporate sector, non-financial sector earnings would be the same, the actual business drivers are slightly different. So usually, I think professional investment management, you kind of try to separate the non-financial earnings growth and the financial services earnings growth. That's why.
Thanks for the clarification. That's very interesting. So now I'm trying to put financial sector in the context of the entire market. Financial sector isn't as big as component of the market share of the market as it used to be, right? Banks and financial institutions were 40%, 50%, even more of the market cap. Do you have any of you have any thoughts about what has led to their current share, maybe 20-30%, right? And are they likely to return to that market dominance?
Yeah, you pointing. Okay. It's too complicated to answer that question in short, because there's two factors at play here. For sure, I think the financial sector has taken a hammering in real terms, in terms of their market cap, and we believe quite strongly that there'll be a surge in the market capitalization. Within this, I think it's important to note that the most valuable financial sector company in market capitalization terms is not one of the big banks. So you need to adjust for those anomalies when you're thinking about it, because I personally believe Commercial Bank and HNB are probably the most valuable financial sector institutions in this country, regardless of what the official market cap list says. So you need to adjust for those. On the other hand, you've seen companies like Expo, rightly, their market capitalizations have grown significantly. So I don't know whether the historical relationship of 40 to 50% is something that it will come back to. That does not change the investment thesis.
I think that's the important part, right? What the index weighting of the financial services, whether it will increase or not, doesn't necessarily change the investment thesis. One thing I want to add though, financial services tend to get valued on book value. So it's almost a cumulative profit. So seasonality or the what your cyclicality of earnings, some of the other sectors face, don't impact the should not impact the financial services market capitalization. It almost always tend to grow unless there's a massive economic crisis in the country. Now we are beyond the economic crisis. So to add to Kanishke's point and your question, I think markets have to be bigger, but how bigger we'll have to let the market forces decide at the end.
So somebody listening to us now will think, okay, financial sector book values have gone from below, they were 0.3% of book at the start of this whole thing. Now they're 0.7 approximately, right?
On trailing.
Huh?
On
On trailing 4 quarters, right? So somebody out there may be thinking, okay, so it looks like they're, should I, what portion of my portfolio should now, if I'm entering now, should be in the financial sector versus, say, consumer stocks or construction, which are potentially also going to be beneficiaries of an economic turnaround. I'm not suggesting this is like a quick snap answer, but if you had to weigh in on this, where would you start?
So I think you have to look at what are the stocks that or what sectors broadly that you would want to have in your portfolio. Definitely, finance sector is going to be one of them. And when I say financial sector, in terms of banks, is going to be something that you would want in your portfolio. But if you look at other assets that you might want to have, for example, the consumer sector, where you're going to see a lot of activity pick up. So companies, again, I have to give the disclaimer, take it with a pinch of salt, but cold stores, Cargills, you're going to see your top line growth. So in terms of top lines, bottom lines, these companies are going to see improvements. So these are some sectors to think about. Financial sector in terms of banks is one sector that will benefit from interest rates coming down. There are other companies that are highly leveraged that will have big benefits with interest rates coming down. So this is another sector that you can think about. As well as tourism. Tourism had a good run at the beginning of the year, but then with some of the results coming out, the highly leveraged positions that you saw, because you saw that the results weren't as great as expected. But with the tourism numbers picking up, we can see, and interest rates coming down, these companies again will see some good growth in terms of profitability as well. So tourism sector. These are some, I'm just giving a few examples. Based on the different sectors that you want to really invest in, I think that's where you would then look at how much you want to allocate.
I'm just curious, if you look at the financial sector's weight in the market, say about 25% it is in the market, I'm just wondering whether in your individual portfolios that you manage approximately, whether the weight is greater for the financial sector.
We are overweight.
Overweight. Would you care to give us like a broad measure of how overweight you are on financials?
I'd rather not talk exact percentages, but we're significantly over 25%.
I think I will agree with Kanishka. I mean, we
I
are
think
overweight.
all three of us.
Yes, we are overweight. And just to add to the answer she gave and to your question, I would say, so I will be overweight the banking sector. I'll also be overweight consumer, right? But also there's another tactical approach we have to take, because there are going to be two different types of fund flows. One is foreign, one is local. So when you allocate, it's not just for the sector allocation you should look at. You should ensure that you have substantial exposure to shares which will get re-rated on foreign flows, while at the same time you need to have exposure to small to mid caps which can give alpha on the back of local fund flows also. So my advice is that not just focus on sector exposure, but also try to understand what shares will get driven by what fund flows and properly position your portfolio.
I think one caveat you should think about is we've talked a lot about the financial services sector, but it's not that if you buy the shares today that you might see an immediate growth, because the financial services sector has done quite a bit as well. So I think you're seeing the shares taking a breather right now as well. So you have to look at a longer term view. I think most of the time when we talk in terms of a longer term view versus a trading call.
Yeah.
So we are looking at the books re-rating, the economic. So you're looking at that 12 to 18 month type of horizon when you're really thinking about, when you're really talking about all of these shares that we talk.
So besides the financial and consumer, are any of you overweight on any other sectors, notably overweight? Let's leave the small caps aside. Look at the big stocks. Any not the outliers, but sectors.
Tourism.
Tourism, you overweight on. Okay.
We also have a substantial exposure to tourism, but two things. One is that we don't necessarily try to build our portfolios to outperform the index in the short term. So are we overweight versus the index is a question we really don't try to think too much about, but we do have substantial exposure to tourism.
Vindhya?
Yeah, same. I think consumer sector shares as well as tourism, and financial sector shares we're highly exposed to.
And another non-sectoral but interesting investment thesis, in my opinion, is dividend yield. You're still seeing elevated levels of dividend yield across certain companies, 10% plus. Important to understand that this is net. So 10% dividend yield, adjusting for inflation, potentially, if you assume you're investing in a stable business, is the equivalent of earning 15% interest that then adjusts for inflation.
Yeah.
So it's very interesting story.
Yeah, because if you think about the dividend yield story, you're really looking at, we were talking about yield hungry investors after tax on fixed income. If you invest at a dividend yield of 15%, what you would get on fixed income versus what you would get through investing in the share market, of course, you're taking on a higher risk of the share price volatility. But it's definitely something that investors can look at as an alternative.
I take pains to explain this to clients because, people sometimes, equate dividend yield of good stocks like a fixed deposit, and it's not. So you need to understand you're taking risk, but if you have the stomach for it, I think it's an interesting story.
And to add to Kanishke's and her point, when the market is deeply undervalued and certain counters are deeply undervalued at earnings, it's that much more safer to take that exposure on dividend yields, because that means there's less downside risks on the shares. So, buying stocks for dividend yield is risky, but at times like this, it's probably less risky than most other times.
Right. So, Kanishka, so we started talking about consumer stocks as an area that you as a fund manager are overweight on, meaning that you have a large allocation to it than reflected in the market, right? What's the thesis here, right? Sure, simplistically we expect a rebound. It looks like we talked about nominal versus real. GDP is real. Is nominal, but if you explain to us the thesis.
Well, I guess so. It's along multiple dimensions. One is a return to normalcy, people spending power increasing once again. I think the other key thing to bear in mind is that a crisis is great for incumbency, and the stock market is a club of incumbents. So when you have a difficult situation that the economy goes through, you have a bunch of smaller companies shutting down or their market share declining, and you have the dominant players having an opportunity to expand their market share. So that plays into this as well.
Yeah, just to add to that, if you look at the December quarter results or the September quarter results of large consumer companies, that was primarily driven by higher markups of products, but also because larger guys can withstand logistic stress and the balance sheet challenges. And given the kind of crisis we've been through, some of the smaller players may not necessarily come back to the market in the same way for the next 6 to 12 months. So
all three of you suggested, Vindhya, that tourism is a sector that you don't mind currently advising clients to have exposure to. Tourism has had a very poor run for several years. They are burdened with loans, a lot of potential restructuring of financial facilities have to take place in the sector. It looks, from the, on a simplistic basis, it looks like it's going to be some time before there's a turnaround in the sector, although the arrivals are up, but you seem to see things differently.
I think, like I said before, every time we look at investing in a sector, actually we look at company-wise, we would look at our long-term thesis. So we don't look at the short-term thesis, but we want to get in when it's fairly undervalued or fairly the prices are more reasonable. So we will look at a longer term hold where we might lose out on shorter term returns. But yes, definitely, I agree with what you're saying. You are seeing, but seeing all of these different problems that the tourism sector is grappling with. But I mean, you have all of these companies will have exposure, and there are a few big names that out here that have exposure outside of Sri Lanka as well. So you are looking at a diversification perspective.
So does that mean you prefer the holding companies, for instance, like Aitken Spence, John Keells, which by their structure have very direct and significant exposure to tourism? Or are you sort of kind of looking at the individual stocks, generally speaking?
So we look at both for different reasons. I mean, we are looking at the individual stocks plus the holding company as well, because the holding company has an additional thesis, right? Because at the holding company level, you're still looking at the diversification and the exposure to that economic growth. So I think the two companies have different theses where you can justify investing in both.
Fund managers don't necessarily like conglomerates, right, generally speaking, because the simple logic being that, hey, you can pick apart and you can buy those individual sectors instead of allowing somebody else to allocate your resources. But it seems a little different here. Asanka, we've seen some of the portfolios that are public that you manage on behalf of large clients. John Keells figures big.
What I would say is that it's always a question of value, right? I mean, so when a particular company, so why doesn't fund managers don't like conglomerate? It's about conglomerate discount, because you feel if you directly invest in a particular company, right, and companies with direct exposure with very simple structures tend to value them better, right? And you feel that in a conglomerate level there's a substantial discount. But so there are two things here. If the conglomerate discount is much substantial than if it has ever been, then that means that there has to be a reversion to mean. And in a country like Sri Lanka, conglomerates offer foreign fund managers ability to get exposure to the country directly. So if we're expecting foreign flows to come back, and we expect reversion, mean reversion on the conglomerate discount, there should be substantial upside. And I would rather speak very generally without speaking about a specific company.
Yes, because what you said is completely true. Like in terms of you wanting to pick and choose the individual share versus the conglomerate, but that depends on the timing of the investment and at what point you're making the investment. Sometimes a broad asset allocation to the entire market makes sense, versus at other times for different market structures or the way the market moves, it makes sense to just narrow the asset allocation. So here, if you're expecting a broader economic recovery, then it makes sense to look at the conglomerate as well.
And does the fact that foreign investors will return to Sri Lanka at some point, and then those events, those triggers are maybe we are at the cusp of those triggers, which is the commercial debt restructuring and which may happen in a couple of months. So conglomerate may be additionally attractive for those reasons.
Yeah, I mean, it's not something that is completely unheard of, right? I think you can think of that is another investment rationale that you can look at as well. I mean, there has to be reasons how you unlock value.
Right.
And foreigners returning to the market is one way that you unlock the value that is there. Like Asanka was talking about, deep discounts in conglomerates can just remain at deep discounts if nobody buys it. So if you have a certain set of investors who will be interested in it, you know that there is potential for the value to be unlocked.
Kanishke, any thoughts on that?
Only thing I can add is fund managers may dislike conglomerates, but we love liquidity.
All right.
To add to the point.
Sure. Let's talk about any outliers here. So we've talked about the financial sector. We've talked about consumer stocks as potential ones. Let me get your thoughts on tourism. You are bullish on tourism stocks as they are currently priced. What's the thesis? What's the idea?
So let me just talk about, give my take on tourism. We feel by about December, our tourist arrival run rate may be at or slightly above pre-Easter levels. And what we need to be mindful is that since Easter, global outbound tourism has actually grown. So us going back to pre-Easter tourist arrival figures is not an achievement. So, but that also tells you the kind of upside. Now, if you are going to ask me about tourism related investment thesis, I think there are two things I want to say. So, when you're selecting tourism related earnings upside, just be mindful of companies whose balance sheet may not be strong enough to withstand a refurbishment or servicing their debt. So that you have to be mindful of that. And another interesting theme you have to think about when it comes to tourism related investment thesis is the value chain. To build an investment thesis based on tourism, you don't necessarily have to buy a hotel stock. In that value chain of service in the tourism industry, you will see companies which will see substantial upside. So those are two things I want to add on to
So I'm
investment
just
thesis.
curious, what kind of stocks are you referring to?
So, I mean, see, when tourism picks up, arrivals picks up, you will actually have a greater pickup for food and
Food and
beverage.
beverage,
That could be one sector, right? And also just be mindful that even in its current fairly dire consumer environment, the southern belt consumption is picking up because tourism is picking up. So that pickup in tourism can actually transform into pickup in consumption, which will benefit consumer stocks as well, other than ones which direct F&B exposure to the tourism industry.
Right. As we get to the end of this, I will ask you about companies that have export exposure. You know, export companies out of Sri Lanka. For the longest time, we didn't have many. We still don't have a lot, but we have a few. What's the outlook here? Is it possible to generalize about these companies?
I don't think you can generalize. If you're talking Sri Lanka as a whole, obviously apparel is a big segment here, and it looks like the industry will have slow going. It'll be slow going for the industry until the end of this year. But I'm coming from an apparel industry background. I can tell you, I'll be surprised if next year you don't see a bounce back, because it's been the orders have been slow for an extended period of time, and the globally it doesn't look like major economies are going into an out-and-out recession. So that means there will be a pickup in consumer spending, and more importantly, an increase in stock levels in retailers. So you probably will see a pickup in orders in that apparel sector next year. But by the time that translates into earnings here, we're talking it's more than 12 months away. So now this is another thing that I think is important to bear in, or something that I think about as a fund manager. I can have my long-term investment thesis, but my first job, I think, is to make money for my clients. And we see an 80% correlation between stock prices and the last quarter's earnings. So essentially, our market prices move according to the last published earnings. So there's certainly we do take positions when we think a company will do well in 4 quarters, but that position is likely to be smaller as a percentage of my total portfolio than a company where I think the next quarter's earnings growth is going to be dramatically higher. So we do time our investments in that way.
To add to Kanishke's point, he brings a very valid, very important point: portfolio construction. Right. So, given the market liquidity versus portfolio size, given the also differences in the investment mandates of different clients, that you may decide to take long-term positions or short-term positions. If you are so large, it will take time to build a position. You'll probably carry a lot more of a share, which is likely to start giving you return 12 months from now on, as opposed to in comparison to another portfolio where portfolio size is smaller, so you will actually build it later. And also the client's investment mandate matters, right? Certain clients outperformance is based on longer horizon, certain clients short term. So I think it's very important as fund managers we realize what each client needs and deliver what the client
No,
needs.
sorry. So absolutely, I was agreeing with Asanka's point definitely, in terms of where so if you look at, for example, the unit trust, you get evaluated on a annual basis whether you like it or not, right? Because the numbers
Annual
are
is being generous, probably on a monthly basis, right?
But versus if you look at our larger clients, they would be happier looking at a longer term build up of a portfolio. So it really depends on who you're catering to.
Right. So let's wrap this up, and can I start in this direction? Start with you, Kanishke. Take a couple of minutes. Any final thoughts you have to put on the table here?
Under normal circumstances, I get worried when everybody around the table says the same thing. But maybe this is not a normal circumstance, it's a relatively extraordinary circumstance. So I do think that there is value. Yes, we all see it, but the market has not yet adjusted. A lot of institutional money has already come into the market, but I think there's a long way to go in terms of foreign money, in terms of high net worth individual money, and in terms of retail money yet to come. As we discussed, the Colombo stock market reacts most strongly to quarterly earnings, and it appears highly likely that quarterly earnings numbers will grow very fast, with very high percentages over the coming quarters. So all of this lends to a fairly robust hypothesis in favor of increasing exposure to equities, and that's what we have already done for our clients, and it's what we are advising clients to do.
Essentially the similar themes. I mean, we started building our positions beginning from, I would say, mostly beginning from this year, and may would have increased recently when the yields dropped off. The point is that when the market is substantially undervalued as this, that in the initial rally, it moves up very fast. This 35% move doesn't really capture the full potential of the market, as Kanishke said. And we discussed certain catalytic events which will happen over the next few months. For an investor who's staying out of the market, the biggest risk is that if they wait until those catalytic events materialize, the market will be another 15-20% up before they come in. Another point I want to add, because I don't want to run the risk of repeating what Kanishke said, is that we are seeing substantial foreign interest, and some of the foreign interest is not materializing because they can't find liquidity. At some point, they are going to say, heck, we'll pay 5% up, 10% up to build the position. So I would say this is just like as the war ended, and we are probably at the beginning of a 12 to 18 month very strong run in equity markets.
Vindhya, last words for you.
So yes, I agree with my two colleagues in terms of where we believe the equity market is going to go. But I don't think we want to leave a story where we say everything is going to be a full bull run. You have to be aware of there are certain things that are building up in terms. I think the biggest one maybe is like the upcoming or the forecasted drought, which might have negative effects on all our forecasts in terms of GDP, food security, exchange rates, interest rates. So these are things that you have to be aware of and look at when making that decision. Definitely, I agree with Asanka in terms that we will see a re-rating of the market, but these are things that you should still keep in mind. And for the I mentioned unit trust. I can't not mention unit trust. I mean, we have all three of us here would have exposure to that in terms of managing different unit trusts, and where investors don't have the time to look at their portfolios. This is the way to go, because these unit trusts are there for the small investor who doesn't have the time to look at the portfolio and invest in the market. So I think that's something that should be mentioned as well.
So having a bunch of fund managers around the table is very different to having a bunch of sell-side analysts, and I think that view has been vindicated. Thank you, Vindhya. Thank you, Asanka, Kanishke. That was a fantastic conversation. Appreciate your time.